Welcome to Alpha Recap, your quick wrap of the day's biggest market moves. We're recording after the close. Markets had wrapped up for the U.S. long weekend, and we've got a lot to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Yeah, lots of volatility to work through from Friday. Big single-day swings, a major aerospace milestone, and some questions about liquidity underneath it all.
Let's start with the headline. SpaceX completed a second Starship test flight on May 22nd. Even though SpaceX is private, that event rippled through public markets. Why did that matter?
Right. So, what really stands out here is that the liftoff reduced program uncertainty. For public companies that supply parts, systems, or services, one successful test can change assumptions about timing, contract probability, and technical risk. Analysts fold that into valuation models, and portfolios that had space exposure got re-rated, at least in the short term.
Short-term repricing from a private company event. Interesting. Okay, now the fireworks on the tape. Several names had huge single-day moves on Friday. Walk us through the biggest ones.
Sure, there was one small cap name that surged about 88%, finishing the day at $3.55 on roughly 76 million shares. Another related name jumped about 20% to $26.42 on about 202 million shares. At the same time, an inverse semiconductor product fell about 7% to $7.72 on roughly 275 million shares. And a second related name plunged about 42% to $2.79 on about 130 million shares.
Those are huge moves, and the volumes were heavy across the board.
Exactly. High turnover. These were well above typical daily volume. When volume is concentrated like that, it amplifies price action. Small shifts in supply or demand, like news, options expiries, or margin flows, can produce outsized percentage moves.
So one core theme is liquidity and participation driving these swings.
Yes, liquidity was front and center. When trading is that dense, market impact goes up. Trades move prices more, and you can get feedback loops where price moves trigger more trading, which pushes price further.
And another big theme was leveraged and inverse products complicated things, right?
Right. And the other thing is leveraged and structurally short products concentrate downside risk. Those inverse semiconductor products rebalance daily to keep their target leverage. That rebalancing can accelerate moves and create volatility that looks different from the underlying sector's fundamentals.
So when that inverse product fell by about 7% on heavy volume, it could mean either a semiconductor bounce or purely mechanical flows inside the product.
Exactly. Hard to tell without digging into the fund flows and the broader sector data. The mechanics alone can push prices. That's why you can't always read a leveraged ETF move as a clean signal of sector health.
And the split performance between the two related names, one up 20%, the other down 42%, that screams idiosyncratic risk.
Absolutely. When names that look related diverge so sharply, it usually points to company-specific catalysts, corporate actions, filings, or microstructure events like low liquidity at certain price levels. Analysts caution that momentum can dominate these situations, so you shouldn't assume the move reflects a durable fundamental change without corroboration.
Hold on. So when you say microstructure, what do you mean in plain English?
Good question. Microstructure is the plumbing of how trades get executed. Order books, block trades, the size of resting orders at particular prices. If there's not much liquidity sitting in the book, a few large orders can swing the price a long way, even if there's no new material news about the company.
Got it. So a big trade against thin liquidity can look like a news-driven crash, but it might just be a technical event.
Yeah, that tracks. And that's why analysts look at filings, regulatory notices, and short interest updates after these moves to figure out whether it was real distress or market mechanics.
We had some debate in the desks about momentum versus fundamentals. How did that play out?
Some participants viewed the rallies as momentum-driven, probably retail-led, lacking immediate fundamental backing. Others argued they could be early re-ratings if new information became available. The divergence really comes down to how much weight you put on price action and volume. One camp says heavy volume supports a durable repricing. The other says heavy volume can also be speculation amplified by social channels and options flows.
So interpretation depends on the analyst's prior. Momentum traders see confirmation. Fundamental folks want corroborating news.
Exactly. And that's why we spent the weekend watching for filings and any corporate announcements.
Let's zoom in on each major element. Start with the Starship liftoff. What are the follow-on implications for aerospace suppliers and defense contractors?
SpaceX's success reduces technical risk and can shorten commercialization timelines in some scenarios. For suppliers, that can mean earlier revenue recognition or higher probabilities for contracts. Analysts said it feeds into discounted cash flow scenarios and optionality models. But it's not an instant valuation overhaul. It's an input that merits rerunning assumptions.
Right. Not a guarantee, but a data point that changes probabilities.
Exactly. For long-term investors, the right move was to use the weekend to stress test supplier assumptions, contract timing, R&D spend, capital intensity, and not to leap to conclusions from a single test flight.
Let's talk about that big rally, the name that spiked about 88%. What did analysts say could be driving that?
Analysts pointed to a few possibilities: options expiries, social media-driven retail interest, and short interest dynamics. Heavy relative volume versus average daily volume often gives momentum legs because it signals broad participation. Still, absent corporate disclosures, a one-day pop that large keeps a lot of risk. Reversals are common.
And the name that plunged about 42%, that looked decisive.
A move of that magnitude, with high volume, usually suggests decisive selling. Either a negative corporate development, margin-driven liquidations, or a breakdown in market structure for that ticker. Analysts recommended monitoring filings and regulatory notices over the weekend to see if there was a proximate cause.
Quick reaction segment.
Wow.
Not what anyone expected.
Yeah, that tracks.
Switching back to leveraged products. The inverse semiconductor product down about 7%. For listeners who use these funds, what's the plain language takeaway?
These products rebalance daily, and that can create a feedback loop. When the underlying moves, the fund must buy or sell to keep its leverage target, which can push the market further in that direction. So the decline could reflect a semiconductor bounce or just mechanical rebalancing. Either way, analysts said these funds aren't simple long-term hedges. They need active monitoring.
Short reaction segment.
Good point.
Let's cover implications by investor type quickly. Long-term fundamental investors first.
Long-term holders should treat the liftoff as a catalyst to rerun valuations for exposed suppliers and contractors. For names that had extreme moves, verify filings, revenue drivers, and whether the price action reflects permanent change or just transient momentum.
Momentum and short-term traders?
Those traders saw volume-backed rallies that might continue in the near term, but also faced high reversal risk. Watch order book liquidity, intraday volume-weighted average price behavior, and options expiries. Tight risk controls were essential.
Options and volatility players?
Elevated turnover and big swings pushed implied volatility up, raising premiums. That made long volatility strategies more expensive and increased tail risk for sellers, especially over a holiday weekend when news flow is compressed.
And institutions and risk managers?
They were advised to review exposures to structurally rebalanced funds. Those products can introduce convexity that complicates hedging. Mark-to-markets and scenario testing for rebalancing dynamics was recommended.
Okay, practical watch list. What should people be monitoring into the next open?
First, corporate filings and news for the names that moved most aggressively. Second, short interest and options open interest in those names. High short interest plus heavy call open interest can set up squeezes. Third, semiconductor sector indicators and fund flow reports to figure out if the inverse product move was structural. And finally, supplier and contractor notices tied to the Starship program.
Right. Cross-check price action with real data.
Exactly. The common thread across all these developments was liquidity-driven repricing. High volume can produce rapid and extreme price moves. The work is separating durable repricing from transient momentum by checking filings, news flow, and fundamental metrics.
Wrapping up then, Give our listeners the top takeaways in plain language.
First, the Starship liftoff mattered for public space exposure. It reduced some program risk and deserves a rerun of supplier assumptions. Second, extreme single-day moves were driven by concentrated volume. That increases the chance of reversals and technical noise. Third, leveraged and inverse products can amplify mechanical flows, so their moves aren't always pure signals about sector health. Finally, check filings and liquidity metrics before treating big price moves as durable.
Good summary. One more reminder. This is informational only. We're sharing what analysts noted and what the data suggested. This is not personalized investment advice.
Right. Analysts note you should verify corporate disclosures and fundamental drivers before making any changes to long-term positions.
Thanks, Matt. Final quick sign-off and call to action.
Thanks, Ryan. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
That's it for today's Alpha Recap. See you next time, and remember, monitor liquidity, read filings, and keep your risk controls tight. If you want to dig deeper, go to stockalpha.ai and ask your questions in the Q&A. Take care.